This is Practical Pivots, the podcast for startup leaders, founders, and investors asking, how do we get to that next growth wave? Join me for sharp conversations with an eclectic ensemble of experts to guide companies to disrupt the undisruptible, turn setbacks into scale-ups, and transform plateaus into pivots. Today, I'm talking with Marc Nager, co-founder and general partner at Howdy, a venture fund with a pretty un-VC name and a non-traditional approach. Marc's been a founder, a startup ecosystem builder, and now an investor with a sharp focus, backing early-stage tech companies in rural Colorado. It's a systems-level bet that remote work, local talent, and long-term capital can reinvent what startup success looks like, far from the coast. In this episode, Marc and I dig into what he looks for in rural tech founders and the one thing that makes him immediately lean in or out. How he helps companies navigate growth plateaus, make counterintuitive pivots, and build momentum in markets that don't follow Silicon Valley rules. And the real story behind the name Howdy, and how it signals a different kind of VC. It's a conversation about capital, community, and the mindset shifts required to build durable companies in unexpected places. Hope you enjoy it. Marc, welcome to Practical Pivots.
Steve, thanks for having me. It's really great to be able to dive deep, hopefully, with you on a handful of topics, because we always have good conversations.
I'm excited to have you. So you just did a big rebrand. Howdy is a pretty unconventional VC name. What's the story behind it, and how did we get here?
Gosh, so Howdy Partners, right? It started as a joke. One of my partners, girlfriend at the time, now wife, was joking, and she said, "If you guys ever rebrand, you really need to do Howdy Partners." And she'd seen us doing our work in rural Colorado, and so much of our approach is human-centric and founder-centric and really relationship-driven. And we design around that, and we use that as kind of like a question in the back of our minds whenever we get stuck on something. What's the best thing? How do we really help the founders? How do we build the relationships, right? And so that's just been really core. And we had a pretty awful, hideous acronym for part of our last name, GCVF. Literally, our spouses couldn't get that right half the time. So we needed a rebrand, something to just capture who we are, why we're doing it, what matters. And we kind of went through the process. There were a couple like really obvious, standard VC names that you could pick off any chart. And then this was the only one that stood out, and it was memorable. Everybody kind of gets a chuckle out of it. And look, we're doing something different, right? We're not a standard VC, and we really wanted to just embrace that and own that. And it was an opportunity to really dig into what does make us stand out, what does make us stand out.
Well, it is super well done. I'm really impressed, having just done a rebrand of an investment for myself. It is really hard to pull off and to be unique in your space, and nice work.
Thank you.
What's the best joke you've heard so far about your new name?
Oh gosh. I mean, literally every 80% of the calls start with just howdy, and not from us, from others. And it starts with a chuckle. So, I mean, the whole thing is just fun. It's playful, but we're making it meaningful. And I think everybody appreciates and still respects it too.
Awesome. So now that you have this new name, can you talk a little more about what your investment thesis is, and how does venture capital work in rural areas?
You bet. So yeah, we explicitly invest in, right now, rural Colorado. Thesis is really around how do we move the needle for rural America? Rural America did get left behind in this last generation of economic development and growth. All the stats, suggest and really point to that as just real dynamic. Politics aside, we can all agree that one of the systemic problems and challenges is how do we create more jobs and opportunity? And our true belief, one of our fundamental beliefs is it's not for lack of opportunity or even competence, right? For folks who might be dealing and seeing and living real problems on a day-to-day basis in rural areas, they just don't have the same vocabulary, the same polish, because they're not sitting in a tech hub like Boulder, right? Getting exposed to that culture every single day. And so our thesis is really about finding those folks who are prioritizing living in these places and seeing different problems from different angles, and then kind of being that bridge for the network, the capital, sometimes, a bit of that polish, the vocabulary, to speak to the rest of the venture world.
So we talked once about this random part of my life where I was doing community development, finance, nonprofit work, and I was actually at the first ever Community Development Venture Capital Association conference back in the 90s. How has impact investing evolved for venture capital since then? It used to be you find a local community, you build everything around it, and you have a giant a giant company that has tons of jobs in a rural area, and it's a very different world than it was back then.
Yeah, right. I think you still have, and I've been dancing around kind of call it the impact space for 20 years now. I've always been um former leader of Kauffman Foundation had a good quote, Carl Schramm, and every entrepreneur is a social entrepreneur. And that's something that really stuck with me. And I really believe, right? Like, if there's no harder career path in life than being an entrepreneur. And look, there's some sleazy exceptions out there that we all know and see and bump into, the scammy types. But 99% of entrepreneurs out there, they just have genuine insights into real problems. And that's something I think we're hardwired as humans to solve problems, right? And then to create value for our families, our neighbors, our communities, our states, our country, our world, right? Society. And entrepreneurship is that like enabling vehicle. And the impact is literally what's created the society we live in and all benefit from, right? On so many different levels. And so from an impact space, right, the penultimate goal for us is to really drive venture level returns. We want to unlock and prove a segment of venture that everybody thinks we're crazy for tackling and running after, right? We want to prove that this is a very legitimate additional segment to the venture landscape. That's just been, frankly, completely overlooked, right? We've got over 80 venture funds in Colorado. 20% of our population lives in rural, and there's exactly one venture fund focused on those companies where 20% of the population is, right? And I think that plays out across the country and really the world.
Our next section, we're going to talk about startup selection, investment criteria, and how do you go about thinking, analyzing startups from that chair. What about it? Let's start by talking about what about it is different from the impact investment perspective. We used to talk about the triple bottom line. Is it just one line at the bottom that has the criteria for rural impact?
Yeah, it's literally the state, the Venture Capital Authority here in Colorado is one of our large LPs, and they just have a strict definition based on population, but on a county level. So it's very binary for us. If the majority of ownership and leadership is in rural, it counts, right? And I think that's it's nice, it's clean, it's simple, and again, super binary. But when we think about like the impact in rural, it's building that tax base, it's building the skill set, obviously the jobs, but the culture as well. One of our companies, Agile Aerospace here in Durango, now employs over 120 people, mostly rocket scientists. Average income there is well into the six figures, right? Versus an average median income for the county that's, less than, roughly a quarter to a third of that, right? And so I think just you think about that, the spillover effects that has, and having those type of jobs and skills build up in a community like this is just profound.
So you're saying there's dozens of rocket scientists in Durango?
Yeah, more than dozens. Yeah, exactly.
That's incredible.
Yeah, who would have thought, right? Yeah.
Where have
So
they
they have
been
a hot
hiding?
fire test stand, right? And it's right next to the airport. And it's where they do the vacuum chamber type testing for thrusters and rocket engines before they actually get put on the rocket and go into outer space. And so they started with this test stand, but then had this unique insight into what if we actually started 3D printing the thrusters ourselves? And what they saw is they would do testing for these big names that we all know, and they'd send the report from the test, and then they get the new iteration back months, sometimes 3, 6, 9 months later. Now, if they're actually printing and creating their own rockets, they can do multiple iterations in a day. And so that's kind of just like technology enabled at the right time as well. Printing in rare earth alloys, right, is not a technology that's been around. So it's really an additive manufacturing company. And this test stand couldn't be, sitting next to DIA, right? It's actually on Southern Ute land here. So they have a unique partnership and, ability to navigate some of the regulations and, requirements around what it takes to build and do this kind of work.
All right. That is fascinating. I'm realizing I should have asked you for a few more examples of the type of companies. What are some of the examples and range of Colorado companies that you've invested in the impact? Let's start there.
Gosh, another great one. Sarah and team at Barn Owl Precision Agriculture grew up in La Junta on a farm. She and her brother and now husband, all from the area, and they are really passionate about seeing small and medium-sized farms succeed in this country, right? we all understand that that's a downward trend, and the big guys have been getting bigger, and small guys have been getting a lot of pressure. And this was really for them a way to get into building weeding robots to mitigate some of the labor and the intensive nature of farming and allow them to compete with some of the bigger guys. And so that they see providing weeding autonomous robots as a way to help small farmers actually compete and secure America's food system, right? And so they're obviously passionate about it. One of our LPs loves to say they know how to speak farmer. I can help them with the tech all day long, but you can't teach somebody how to speak farmer, right? And so I think that is a common thread throughout some of the other companies in our portfolio as well, right? Sarah and team know what it takes for a small farm to be competitive, exactly what they need from the technology, right? And then they're able to actually turn around into it. And so they're a great example of a company off to the races and deploying a massive fleet this next grow season. Fun to watch.
It's amazing. When you hear the word rural venture capital investment, it sure doesn't sound like there's going to be this level of high tech. I don't know how you help the branding to let people know that this type of level can be achieved in these rural areas is impressive.
Oh, absolutely. It's back to this. It's not for lack of competence or insight. It's just a different angle, a different vantage point to see some of the problems that, frankly, a majority of Americans don't see if you're sitting in a metro hub, right?
Can you give our audience, well, so anyone, La Junta is somewhere in Colorado. That's all you need to know. We will reference a lot of smaller towns.
Eastern Colorado. Yeah.
So can you give us an idea of like what your average week, average month, how many of companies are coming across your desk, and how many of these do you have to make decisions on with the amount of funds you have? And then we'll go into how you make those decisions.
Sure. Yeah, I mean, when we started this 8 years ago, pre-COVID, mind you, the number one question, frankly, like experiment on our side was, are there enough companies? Is the deal flow going to be there?
Mm-hmm.
I mean, in the first year, part of the effort was building relationship and trust. There is a cultural divide in rural Colorado, and we really refer to it as like the guilty until proven innocent mentality, right? There's been a lot of folks that fly in with all the answers and then leave and never actually provide the solutions,
Mm-hmm.
historically, right? And so that's just part of the skepticism. So we spent literally hundreds of nights. I had a camper van, one of the original Winnebago rebels, and Corey and Jamie, my partners, had their own, right? But we literally camped and drove around the state and just built these relationships and cultivated, from the folks around the co-working spaces to the local entrepreneurs that were kind of the success stories and hidden corners, economic development directors, some of the, the banks, the loan funds, the whatever, right? And through that, we built a deal flow engine that now we see at least 250, 300 companies a year of like some level of qualified on the front end of that funnel. And then we end up with, deep diligence on, I think last year it was like roughly 60 companies.
Huh.
So, I mean, like our stats we are seeing and going deeper and investing in more from a percentage basis than a traditional venture fund, but they're not crazy. They're not, it's not but one out of every three deals that we're seeing. Like the deal flow is not the challenge, especially in a post-COVID era where a lot of these rural communities are actually seeing population growth and a bit of a resurgence for the first time in decades, right?
That's incredible to hear too. Your startup investing firm has a startup story. You guys are traveling around, living in your garage. It just happened to be a traveling garage.
Oh yeah, like I always joke, venture funds, especially small ones, not chasing big AUM. We're like a fixed income startup.
That's perfectly said. Okay. Investment criteria. You see all of these deals. How do you make your decision that these are the right ones? And then we'll get more specific on that. So in the broader theory first.
Sure, yeah, like look, we probably end up taking more meetings and leaning in as early as possible, right? So our criteria on the front end comes with a lot less assumptions. Um, the thing that we love to hear the most from a founder is, I think I'm doing something different, or I believe in a different way of doing things, or I haven't, right? Like normally if you're a VC, you're just skeptical of those from day one. But like back to the barn owl example, right? I think we actually have people living at a different vantage point, looking back into society and economies and businesses with a different vantage point. And for us, that's the really intriguing part, not the disqualifying part. But once we dig in, we're really looking kind of at the basics, right? Team, product, market, business model, financials. So those are my 5 things. The thing that we probably end up discounting a little bit more than some VCs is market. And we have a fundamental belief that not every company should be coming in pretending like they're going to be the next unicorn, right? I'd rather see that bottom up strategy and pitch on how do we get our first 10, 100,000, 10,000 customers, not how we're going to take 1% of a $1 trillion market, right? Because we all know that's wrong. But if you have a credible, bottom up type strategy in view of how to just solve the problem you set out to solve, I think that's really interesting. And that allows us to set the goalposts in a much more realistic way. We typically underwrite companies more for where the realistic outcomes are. I think it's over 80% of acquisition and M&A activity is still between like 20 and $80 million. So it's really funny to me when you think about the big VCs and kind of the traditional startup lore and advice. It's all geared for the $1 billion exit, right? And that's a paradigm, a mind shift that we force onto entrepreneurs rather than kind of aligning with the stats and say like, let's talk about how you build a $20 million revenue company and why that's an amazing thing, right? And why that hits the sweet spots and how it can be profitable, right? So we really focus on optionality and maybe only raising 1 round, maybe 2 rounds. We'd love to see that with a company, right? Get to profitability, and then we at least have the optionality to choose. Should you raise another round? Have you really unlocked that upside potential? Because it's not about not chasing the $1 billion dream. It's about not building for that and swinging for the fences at all costs, in spite of where the reality of almost all venture outcomes actually land. And so we actually also feel like we see a little bit lower loss rate and failure rate in that as well.
You sure sound a lot more like a growth equity investor than venture capital with some of those talking points.
We've heard that a bunch. Yeah, and I think actually some of the stats from our portfolio over 8 years it's supported. I mean, it's still venture, still risky, still wildly unpredictable. But yeah, philosophically, I think it's just ludicrous to force every entrepreneur to aim for the moon from day one when they're still trying to figure out what a product market fit might even look like, right?
Yeah, I like that so much more. It aligns so much more with my interest level and what I believe is right, which is growing. You should build great companies if you can, and you're not a failure if it doesn't hit $1 billion. And you shouldn't close it if it doesn't hit $1 billion too.
Right? Like, and it kind of brings up back to the Howdy rebrand, right? It brings up this almost like integrity gap that happens in venture where you have this completely unrealistic sales pitch that the CEO's founder's job is to convince everybody to believe in. Right. And not saying that's completely over the line. It's just, it forces there's a gray zone there, right? Because you don't really know. But back to the more realistic, more practical approach to venture building, right? I think folks who opt into living in a rural community, small towns, tend to default to that for many reasons already.
So nice. If we could get rid of the total addressable market slide on every investor deck, I would be a happier person as well.
Totally.
Okay. If you had to cut your due diligence process to 3 founder signals, what stays and what goes?
Ooh, 3 founder signals. I think it is the unique insights into even into like unsexy businesses. We got a thumbs up. Nice. But like, we love those businesses in those markets that are non-obvious, right? That there's not going to be a ton of, like, we have one company, Enroll ML, that's focused on admissions, applying AI and machine learning to the admissions process for universities. And they're just finding that they can take this incredibly dismal yield rate, basically from the number of acceptance letters sent out to the number of students that actually show up. Turns out that's closer to like 15%. And if you could
Mhm.
change that from 15 to 20, right, you've changed your entire funnel metrics, right? And admissions is this kind of like dark little corner in the ed tech world that there's not a lot of companies running after. But we found a founder who has had some real experience and a unique insight. And anyway, love to see things like that. Three things, other two signals, right? Like team's competence for the stage. I think back to some of the paradigm shift, we really want to see, right? Like, are you at the 0 to 1 product market fit? Do you have the right people for that stage? Because we've seen it both ways, right? We've
Mhm. Mhm.
overhired and we have the folks who are great at building and running really huge businesses or business units. They're not so great at the 0 to 1 stage, despite maybe a really incredible network and resume and, you know, reputation, right? Doesn't mean they're not great. It means that they might not be great for that stage. And you can have the vice versa. You can have the 0 to 1 founders that are hanging on to things that actually have product market fit.
Mm.
And I actually love to say entrepreneurs make great firefighters. That's why they build companies, but they also make great arsonists. My friend, I think Julie Penner came up with that one. But right,
Beautiful.
they can get in the way, and they can really cause you a 0 to 1 founder who is exceptional at that can really cause a lot of damage and distraction as a company gets more into that scale mode when you need to focus and have structure and repeatability and right. Um,
That is a quote, a one-liner that says so much.
right, totally. So right founders, right stage. Um, third, I think more back to just that like capital strategy. We're looking for founders that are realistic. Um,
Mm.
we we've had a number of cases where we meet founders. They have the pitch where they've been doing the dance on the Front Range of the Bay Area, and they meet us, and we actually push them on like, what if you raise less money? How long does it take to get to profitability, right? And then we actually do like the cap table math and help show them why being a little bit more responsible and thoughtful and methodical about those early stages and kind of the validation, creating optionality, focus on profitability could end up being just a better thing for them overall too. Um, right. And that ends up being some of the most fun conversations because we end up in this real like partnership to figure out what's the right capital strategy for the business, not like what is the entrepreneur trying to pitch us and sell us on as the right
Yeah.
strategy necessarily. And sometimes the entrepreneurs are great too. And if they have that, we love to see it.
How do you get these entrepreneurs? All right. So I've been on the circle where you're on the circuit where you're supposed to just, if you don't blow enough hopium, then nobody believes that there is enough hopium there. So it has to be escalated by 300% or nobody even believe, because everyone's going to take it down by 3/4 anyway. How do you get an entrepreneur comfortable with the fact that you're real and you actually want this realistic information after every other signal they've gotten from the market is to not be real?
It's funny, actually, like it's almost like it's not hard. It almost comes as like permission to just
Mm.
like take the hat off. And you see this like sigh of relief. And like literally sometimes I've seen this like physical, like, whoa, really? This like, okay, this is a fun, right? And you just see them physically and emotionally just lean in to the conversation in a way that's really refreshing. Um, and so that's something I think we're lucky to see. Look, and it's not like I can't say that the strategy is completely proven in terms of creating that. Objectively, I think we're on our way. It has all of its benefits, and if you're going to be on one side of the fence or the other, this is so much more of a genuine side to live on, and have build a real relationship and trust with founders, so that when other problems or other perspectives do come up, you're starting from that, not kind of second guessing like, are they blowing smoke again or not? To your point.
Yeah, those are great three. Thanks for coming up those off the top of your head. The non-obvious and the super niche information I find particularly interesting because the other signal that comes out of that for me is that the entrepreneur is so interested in the problems of the space that they've gone really deep, which means that if they need to pivot or the business model is wrong, they still get it all versus what happens a lot in SaaS where it's too high level and you're just looking for who wants to buy something and then filling that. Does that resonate?
Totally. Yeah. AI is like this interesting layer on top of that now
Hmm.
because I think just the world of SaaS is getting flipped on its head, especially the B2B side, right? Like what it takes to build a SaaS company, right? Chat might be able to do most of it for many large billion-dollar companies in a matter of hours or days right now. So
Thanks
it
for
flips
bringing
that
that
whole
up
lens.
again.
Yeah.
I've been trying not to think about that for a little while.
Yeah, yeah. It forces a good, healthy question of, all right, where's the value add then, right?
Do you have one something that a founder says in a pitch that is like your one signal that you or your investment partners are known? You all look at each other in a room and are like, okay, we're out.
Um, there's a self-awareness thing, and I don't know if it's like one thing that gets said, but I
Hmm.
think we've had some experience with some founders that say all the right things, and then you kind of get into it, and you realize that the self-awareness of where they're at on their own journeys, what stories that they're telling themselves and everybody else, starting to get out of touch with reality. So we end up doing a bit of diligence around that, especially with like references, because, again, hard to just directly ask somebody if they're self-aware, because I think everyone on the planet thinks they probably are more than they actually are. Um, but, poking at some of the other historical relationships, especially with former co-founders and that kind of stuff, that's become even more important for us to double click on, not just like, how was it working with this person? It's like, no, tell us about their level of self-awareness. That's yielded some really great insights for us. So probably a big learning and something we've added to our process in a meaningful way.
That's so interesting. It feels like the world of executive recruiting or executive interviews and recruiting is overlapping with with your entrepreneur kind of due diligence.
It totally is. And I'll be the first to say that like we have all these heuristics that we're striving for. And at the same time, we also have like this reality of some of the best founders might not actually be like the easiest people to get along with. Right. And so as a human, as a VC, especially leaning into this market and being on this side of fence, we're not just looking for people we can sit around and have a beer with all the time. Right. It's you're looking for people who have that, like they might be a little bit of a pain in the ass. They might have been, the kid at the back of the room causing trouble and mischief. But are they the right kind of crazy, in terms of the
Yeah.
entrepreneurial sense to really take on a big challenge and have that tenacity and rally the leadership? Can they rally and attract a team and other investors and do that in a good way that doesn't cross into that, again, I called it the gray zone earlier.
The right kind of crazy, the firefighter versus arsonist.
Yeah, totally. Yeah. And you never
Uh,
really know. Yeah.
so interesting. So let's talk a little bit about this podcast and my company in particular. We focus on how to get these startups unstuck and moving forward to their next growth phase. And every one of these startups is going to hit they're going to be flying, they're going to be down, they're going to be up, they're going to be down. I'm wondering if you have some keys to success where well, let's start with diagnosing the problem or the problems first. Where do you see your companies most often hit plateaus?
Um, we kind of have two separate, like we invest at pre-seed and seed, and I think we have kind of like a little bit of a different pattern for both that we see play out. But like on the pre-seed, it's hey, we got the first friends and family kind of customers, and they lean into scaling what was working with their immediate networks too soon, right? So how do you distinguish the signal from those early adopters and believers in your product or service? Um, and know what to be the right aspect of that is to be scaling, or should you be scaling? So I think we see that a bit. And then you have the more established companies that I think have a good, like established credible channel and a predictable acquisition cost, but then they plateau. Then they find like, oh man, we've covered the landscape in that channel. Do we need another customer? Do we need a different channel? Do we need right? Do we need to completely redo the product? And you see teams kind of thrash there. And right, the product centric teams tend to run a product and say, no, if we build this, they will come, right? Like we just got to do this,
Right.
this different. The more sales focused founders tend to be like, all right, no, we're just going to go sell the new, as soon as it gets harder or it's more expensive, we're just going to sell to somebody else, a similar version. And sometimes that's the right strategy, sometimes not. But, the discipline around that thrashing when they encounter that is more predictable and harder. That's the point, to engage and diagnose the problem, to your question.
That's the way I haven't thought about it, is that everyone goes back to your home base. If you're in nail the whole world is a hammer type of situation, I definitely we're going to sell our way out of it regardless if we have product market fit or anybody else wants it, I feel is the one that I see the most.
Totally. Yeah. Right. Yeah. That fits a lot of founder profiles.
Are there some quick hits that, the Advil effect of at least something that works for a lot of these founders? So I'll ask you for some of the patterns and then some counterintuitive things that some of these founders have come up with in companies in order to get out of their plateaus as well.
Right. Like we talked a little bit, the right team at the right time. I think that's actually more one of the Advil, just a quick, like, real audit. Are we really doing the things that we're all best suited for? And what are the gaps, if so? Because I think sometimes as investors, we want to believe founders can go the whole journey or are the right thing at the right time. And sometimes founders really want that for themselves, but that there is a process, a cycle of really kind of being honest about that. The intellectual honesty, the self-awareness, are the right butts in the right seats for what's needed right now. And oftentimes you'll find that there's a gap, and that's not a bad thing. It's just, let's own that. Let's embrace that. Focus everybody on what they're really good at, so that we can objectively plug that hole.
Do you have some solutions? Sorry. Do you have some solutions that have worked for one or two companies that's just become key, that you are clear that you want to introduce this to the rest of your portfolio?
I wish we had like a magic. Honestly, one of the more successful strategies has just been, because as an investor, you end up with a special relationship with, just tied to economics. And there's some of that you just can't get away from, right? But having a third party, somebody like you, come in and actually be a little bit more like, hey, here's what I see, right? You're not an investor. You don't have skin in the game. You can truly have, like, a true third party stance. I think that ends up bringing a different level of credibility to some of the challenges and the speed at which they're willing to address those challenges. It doesn't happen all the time, but it's happened a few times and it's worked really well. And we've leaned on some of our friends and advisors, folks with a lot of experience like you, to come in and help do that. So that still feels like one of the default plays in the playbook to keep running.
Well, thank you very much. I appreciate that. And thanks for bringing me in. I was thinking of teeing that up more as, you have the BDR solution and like this new package of AI outreach, but I really like me being an answer instead.
Yeah, right. And very practically, right? I think you've engaged with 3 of our companies. I think you helped one of them actually make some moves and strategy shifts, that is pointing them in really the right direction, and they're getting a lot of traction there. I think one of them is, let's keep our fingers crossed. And then another one is, right, I think it pointed them probably into just having to deal and own and reckon with some of the business model challenges that were, maybe not overcomable. So, yeah, not to say that there's a solution, but the goal isn't always to solve all the problems, because startups are so complex. It's just to speed up the cycles, because to pretend like anybody has all the answers swooping in, like, that's ignorance, and great example of that, and needs to be avoided. But can you speed up the cycles is really the question.
That is a really good point. So let's go a little bit deeper there for a second before I do a couple wrap up questions. So we looked at we've talked about 3 companies together. One took off, one is working their way through it, one is kind of going through deeper changes. And it kind of looks like a lot like a normal venture capital portfolio. You're going to have some that make it, some that stagnate, and some at the bottom. Are you always thinking, so speeding up the cycles, how do you Yeah. How do you keep that in mind as far as it's just now a pattern for you? And then how do you express it to your entrepreneurs? I hate to say this, but you're in the bottom, you're in the, you're in the bad pattern.
Um, yeah, that's actually something I've gotten really comfortable doing. Help and just as like, we're a 2.25 person team. We have 50 companies in the portfolio now. We have to be a
God.
little bit ruthless with that. And
Mm.
it's not because we don't care or want to be helpful, but we have to have a strategy for engagement, just like any business that's got limited resources, right? And so I think just getting a little bit programmatic with that and helping entrepreneurs understand where they fit in that and that you're still here and they can call anytime, right? It's not that the door closes, it's that the level of proactive engagement does shift and has to shift, you know, just by the nature of trying to run the business that we're in.
Yeah. That is a shockingly hard balance to make, especially when, so in general, in venture capital, you're making a minority bet, so you don't have control over a company. So you're an influencer. Is that, can you just talk about the dynamics of that for anyone who's not fully
Totally
grasping
right. Like
what this
sometimes we'll take
means?
board seats. We've taken, I think we sit on like 10 or 12 boards out of the 50 right now. Well,
Huh.
roughly like 30 something active. Um, the, uh, yeah, you have influence, but not control. Even if you have a board seat, you have some like kind of technical control, but founders at the end of the day, you have one choice. You either believe and support the CEO and the founders or you don't. And if you believe and support them, it's showing up and trying to help like influence them in maybe patterns, pattern matching, or skills gap, or back to that self awareness, or right, accelerating some of those cycles. But you don't have control. Not at this stage. It's just not a scalable strategy or an effective one because nobody. AI still doesn't have all the answers for how to build a
Yeah.
successful startup. Right, 8 and 10 are still likely to fail. So.
So you started this whole career journey of yours as an entrepreneur before going into investing. Uh, what kind of surprises you most after you've been in investment land for so long on the other side of the table that you would never have guessed as an entrepreneur?
Oh man, entrepreneurs have this, and look, I'm totally guilty of being like an optimistic. I want to believe every entrepreneur that I meet because I was that entrepreneur, and you have to be a little bit like naive and a tiny bit arrogant for like believing that you're going to bend, you know, the reality of the world around you to, create this really innovative, disruptive thing.
Yeah.
um, and that just takes a certain mentality and level of optimism that you want to believe. The thing that I've learned the most though is maybe quickly like the flip side is I also believe that like PhDs also don't make great entrepreneurs most of the time because they have all the reasons why it won't work or they think they have all the reasons why it will. We all know that's wrong too. Um, but I think maybe the biggest thing that is both just like a reality and frustrating is just timing. The influence that like timing and macro markets, whatever, timing of so many things around the context of any given startup matter. Um, and so many things can happen to a company around a company that they have no control of. And that really might define, and in a lot of cases, really does define success or trajectory or ultimate outcomes, right? And it just can't be ignored. It's understated at the very least.
Where where is this in the literature? I could not agree with you more. I feel like it's the number one thing that I've learned in business is everyone teaches you to be great, to find great companies, to do your app, to be amazing at what you do. And then 50% of the success of your company or more depends on when you did it and what happened and the timing of the market. There's a stat about how much of VC profits get made in these little 1 to 2 year sprints where the market's actually hot and nothing else ever matters.
Totally. Yeah. Vintage year for venture funds actually
Vintage year.
matters more than anything. Yeah. Yeah. Absolutely. Right. And it's how do you actually layer that all the way onto that like human level of just crazy optimism and belief? It's it's a hard thing to reconcile because nobody really knows on the timing thing, right? That's a crystal ball exercise. And as an investor, the only proven strategy is just kind of have like consistency and try to be thoughtful about the timing. You're not going to
Yeah,
predict the next COVID, right? That was on exactly nobody's bingo card in
no.
2018.
And I also think about kind of all of the predictions in the dot-com crash, where the investors were all, or the analysts were all correct that it was going to crash. They were just off by 3 years. And
Yeah,
so if you were off by 3 years, you could have made a lot of money.
totally, totally.
Um, Mark, is there anything else you want to share with the audience that was on your mind of all the questions that we missed that you want to make sure we hit on today?
Um, Look, I think the world of venture capital and the world of like building companies is completely getting flipped on its head with AI. It is. I don't think AI is it is the next wave of tech, and I think it is more profound and fundamentally different. Um, we're seeing companies need to raise less capital, the funding cycles, right? What it takes to actually get up and running product market fit, or at least MVP, right? The human side of that still really matters. And is in but so many of those dynamics and assumptions around kind of that 0 to 1 are completely shifting, and I think the next generation of that AI technology as it develops will change the next phase as well, and I think that will actually challenge, and it already is challenging, uh, venture funding and the capital landscape. And so, right, I think on the capital side, I have a friend who used to be a partner at one of the big name VCs in the Bay Area. He left, very successful, and he left and he said, Mark, I'm going to launch a $20 million fund. I'm like, you could probably fund that yourself. Why 20? Right? The
Yeah.
last deal he had done was 300 million in funding. And he's like, all the smartest people I know, they only need 250,000, 500,000 to get up and going. Right? It's different, and none of the big funds can touch them. And so I think we're at this point, really, really critical and potentially high impact, you know, inflection point here of what it takes to build a company and what that means for places like rural, right? And being able to build with smaller teams and less capital, that really lends itself to some of these smaller region-based or sector-based kind of thesis and focus. And if you're a startup or an entrepreneur, being thoughtful about how you play into that dynamic as well. Because we have two types of companies that come in our front door right now, like the new age and the old school.
Mm.
And you can see it in a pro forma without even meeting them. Oh, this is the old school funding model, right? You're going to raise 3 rounds of venture capital. It starts with $1 million and then it's 3 million, right? Like, and that's the playbook that we used to all have to subscribe to even 3 years ago. But
Yeah.
now it's a different playbook. Um, that landscape has changed, and I can't emphasize just how quickly it's changed and is continuing to change for even every startup in our portfolio. So, fun time to
Well,
be an entrepreneur or investing. I just a party of it's fascinating.
thank you so much for making sure we heard that, because that could not be more important as far as trends go, and probably the most impactful trend change in decades.
Yeah, at least, yeah.
Mark, how does everyone find you after the show, and who should be reaching out to you?
Howdy.vc. Nice, awesome domain that you can find me. Mark, M-A-R-C, at howdy.vc too. Feel free. You got any ideas? If you got any companies or you want to move to rural Colorado, I'm your guy.
Perfect. Mark, thank you so much for being on Practical Pivots with me. It's great to talk to you again. I really appreciate it.
Great. Thanks, Steve.